Now we are going to go back to our focus, the price of ethanol futures. The price of the contract, that is, at the Chicago Board of Trade has more than doubled since it's debuted on the exchange last March. But is the market overheating? Well, David Morris is the vice president for the Institute for Local Self-Reliance and the author of The Carbohydrate Economy. Morris has also been an energy policy advisor to numerous presidential administrations. He is joining us from Minneapolis, Minnesota. Welcome to In Focus, David. Thanks so much for being with us.
Well, sure. Thanks for inviting me.
Talk to us a little bit about these futures contracts. I mean, at what point are ethanol futures overheated?
Well, right now it's an astonishing sort of confluence, sort of perfect storm on the upside for ethanol. I mean, you have it's doubled in the last couple of years. It's going to double again in terms of production in the next couple of years. You have $65 a barrel oil, which means that you could actually sell ethanol at a profit right now without any federal incentive. But you still have a federal incentive of 51 cents a gallon. And then you also have the energy bill from last year, the end of last year, August of last year, which refused to give immunity from liability for MTBE manufacturers. And so as of this month and next month, most oil companies are saying we're going to use ethanol as our octane enhancer, starting with the driving season. So you have a lot of different events, plus you have a 7.5 billion gallon mandate for ethanol at the federal level. That is, the federal government is mandating almost a doubling in ethanol consumption. So you put all those things together, and this is a no-brainer. It's a no-brainer probably for another 12 months or so, and then things might calm down. But right now, this is the best of all possible worlds for ethanol producers, and it's why the ethanol industry has changed from a internally financed industry, or the agribusiness groups like ADM and Cargill being involved in it, to Wall Street and investment banking getting involved very heavily.
David, you mentioned this price margin here. Of course, we were just talking about the futures, but do you think the people producing, you just mentioned the ethanol producers, the farmers, I mean, are they seeing this money in their pockets or not?
No, I mean, people should understand that the ownership model of ethanol plants in the late 1990s up until 2002 was a 40 million gallon a plant farmer-owned ethanol facility, which meant that the farmers that supplied the corn within 50 or 100 miles of the biorefinery, as I call it, also got the dividends. From a farmer's perspective, ethanol demand increases the price of corn, but very marginally, maybe 10 or 15 cents a bushel, whereas the dividend that a farmer will get from owning a piece of an ethanol plant will be between 50 cents and $1 a bushel each year. So the farmers do very well when they own the ethanol plant. But starting in 2004 and increasingly today, the typical ethanol plant is 100 to 130 million gallons in size, and it's absentee owned. It's much too large to be owned by the local farmers. And so what we're doing now is increasing dramatically the amount of ethanol. That's wonderful from an oil displacement strategy, but we're beginning to uncouple the benefits of ethanol, demand increases in ethanol, from the benefits directly to the farmers who cultivate the raw material.
David, I want to bring you back to a point that you mentioned earlier, saying that the federal government is essentially doubling the mandate. There are some critics out there saying that basically the amount of fossil fuel that it takes to get usable ethanol is enormous, that it's not worth it. What would you say to that?
Well, a couple of things. First of all, if you talk just about oil, there's 8 gallons of ethanol that's produced for every 1 gallon of oil that's actually used in either the growing of the corn or the converting of the corn into ethanol. And the reason for that is that the major input into growing corn is natural gas-based nitrogen fertilizer, and natural gas is basically the fuel that's used in the ethanol plant. So from an oil displacement perspective, there's really no controversy.
Okay,
if you're talking about it, you're talking about it overall.
Go ahead, finish your thought, David. I'm sorry, we're getting squeezed on time.
Okay, if you're talking about it in terms of overall fossil fuel energy, then the ratio is about 1.5 BTUs out, 1.5 units of energy out for every 1 unit of fossil fuel in. So it's a positive.
Okay, David, thanks so much. Sorry we had to cut it short. More In Focus in a minute.